What I'm interested, just to set some background, is for you to explain what you do, the business you're doing, and kind of the topical areas that you're working in with sustainability.
Yeah, certainly. So my name's Tim Dee-McCullogh. I founded Ancorum, which is a dual sustainability and financial reporting practice. Really, I focus at the technical end of sustainability, governance, risk, and controls. So really, that could be anything from implementing a new ESG reporting framework, building the control environment around that reporting, and also seeing how we can actually use that ESG data to inform meaningful business decisions at the strategic level. So dealing with boards, the audit and risk committees, really just embedding ESG into business as usual decision making.
Let's start then with the sort of the financial professionals that you're talking to. So these people are already familiar with having organizational data, they're already familiar with having to summarize that data, and they're already familiar with reporting requirements through, say, accounting processes. What is then the main difference between what they already know and then being able to move sideways, let's say sideways, into the sustainability sphere as well?
There's so much variety within the accounting profession. Some people are more clued up on ESG and sustainability than others. Quite often, a financial controller or head of reporting has been told you need to upskill on CSRD, and at which point they've never had to deal with ESG reporting before, or even non-financial reporting. They've not had much of that to deal with previously. And again, they understand the governance, they understand the process, but really all they would have seen is maybe some elements of social impact or some elements of greenhouse gas emissions being reported, in the front half of the accounts. But a lot of the time in a large group, that's really investor relations that has dealt with that historically. And all of a sudden they need, they're thrown in at the deep end with this. Um, so really with them, I'm working through the basics, saying, okay, well, let's get you up to speed on carbon accounting, because I think that really is kind of step one on out of many iterative steps. And then once they're comfortable with that, okay, let's now think about broader environmental, broader social risks and so on. The one thing that really does throw accountants out of the water is the idea of double materiality that we see with GRI and CSRD. The financial reports, the financial materiality side with risks and opportunities, accountants will understand that. You've got existing enterprise risk management frameworks where you've got the risk matrices, likelihood times impact, and so on. That is very recognizable. The challenge is more on the impact side in terms of understanding the stakeholder materiality perspective. And that's really where I say, well, look, investor relations already do this to some extent. We need to link in with what they're doing, with what the first principles sustainability team might be doing, because they'll already know who our critical stakeholders are going to be. And from that point, we can then do a meaningful double materiality without reinventing the wheel or, taking it to the nth degree.
Are companies making the wrong decision to give the reporting of sustainability information to the financial teams?
This is the point where I give the typical accountant's answer. It depends. One size fits none. There's no right or wrong way of doing this. Really, what I think is critical is the corporate culture of the business, and allowing that to really, if you've got the right people in the right places, allowing that to define the decision. I think in favor of the finance team running with these disclosures, data is data is data. Who else in the organization knows how to get data from A to B, put controls in place, get it through an audit, and present it to the market in a way that people understand? That's the finance team. But on the other hand, the sustainability team, and bearing in mind that there are so many more routes into being in a sustainability team than there are into, say, financial reporting. Financial reporting, you do your accounting degree, you get your chartered status. it's fairly a linear process, whereas you could have a chief sustainability officer who started out as a receptionist and then went through the ranks, through facilities management, through monitoring energy efficiency and operations and so on, and finding them in the CSO role. So really, I think it's having the right skills and the right attitude more than it is a job title. So long as they've got the infrastructure in place there, the reporting, the resource, the actual interest from the board, from the audit and risk committee, that, everything in place they need to succeed, that's what I'm more concerned about than a job title.
Now, you just mentioned the role of the board in some of these processes. How interested is the board in the content of the reporting? If we just ignore the process of sustainability now, we just focus on this kind of document that maybe gets published once per year. How interested is the board, in your experience, in that document? And then conversely, but related, how interested should they be in this information?
Again, there's no one single answer here. I think it makes a big difference whether someone's a CSRD reporter, say they were caught in the first wave of CSRD, or if they're say a large private equity backed group that suddenly find themselves in scope. Certainly for the listed businesses, the primary concern is, what's this going to do to the share price? What will this do to our credit ratings? And indeed, a lot of the pre-CSRD content in the sustainability part of the report was already driven by what Standard & Poor's and Moody's wanted. So the board do take an interest. Where they get disinterested is in the volume of reporting. And certainly, if you're adding, all of a sudden you're adding 100 pages to your annual report, and in some cases more than that, you can see the non-exec's eyes just glazing over with the volume of information they need to read. But ultimately, in that space, it's really, what are we sending out? What are we communicating to the market? If I look at the private groups, and in the UK especially, there's been, unless your revenue is over £500 million and you've got more than 500 staff, your public reporting requirements have already been very minimized. You already have to provide full financial statements, for example, which goes above and beyond what some private businesses in the EU have to do. But when it comes to the front half and the narrative in the front half of the annual report, generally it tends to be very boilerplate. All of a sudden, when these businesses, or if these businesses do come in scope of the final wave of CSRD, the boards are starting to think, oh, we can't give boilerplate anymore. We can't give standard wording. What is this going to tell our customers, our suppliers? Particularly where businesses are, say, family owned, or there's still a heavy founder involvement in that business, there's very much a tendency towards green hushing in the UK already, because people just don't want to be caught out. We've got so many political scandals, they don't want to be caught up in one of those. So there's definitely been a trend towards underreporting for quite a while now. But what's really driving the change is, let's say they're a major supplier to, say, a FTSE 100, S&P 500 business, and then just to stay in that market, they're realizing, oh, we need to actually give decent, assurable, auditable ESG data, and that's driving the narrative more at the moment.
On the topic of the annual report and of putting sustainability in these published documents, you mentioned the concept of, or you mentioned this concern about share price. And so obviously under the CSRD regime, and to a degree under the GRI voluntary reporting, there's the concept of these IROs, impacts, risks and opportunities, and you've already mentioned this, right? So we've got risks. Now, it seems to me that the minute you transparently start talking about material business risks in a public way,
Yeah.
you're threatening your own share price, especially if you don't have much to say in the way of mitigation. And the same goes when it comes to negative impacts, is that there is a self-interest reason to downplay those things. So on the risk side, obviously you're not incentivized naturally to expose the investment world to the things that could lose your company money. I mean, that's what a risk is. That's how it's framed under the
Yeah.
CSRD. It could be a loss of some financial benefit. And in
Mm.
the impact side, you don't want to disclose negative impacts due to the reputational impact,
Yeah.
the reputational risk, which becomes a financial
Mm.
risk. How do you assure reporting entities that being transparent about this stuff is a worthwhile enterprise in light of that kind of obvious problem?
Yeah, and the incentive in practice, I find, is that they'd want to put a material negative impact into a risk rather than the impact column. Which it's a nicety, but it does change things quite dramatically in how you present it. I think really, at least from the UK and Irish perspective, listed businesses have already been publishing their principal risks and uncertainties for at least the last decade, closer to 20 years under various corporate governance codes. That's an established part of the annual report. When we get onto sustainability impacts, and bearing in mind these are viewed from the perspective of a far broader range of stakeholders, there is certainly still that reticence to be transparent about it. But what I say is really, well, you've got an opportunity here to present how you're dealing with this issue. It's not like a bullet point list of just saying, here's an impact, but you can say, these are the mitigation factors we're taking, the steps we're taking. This is how it's informing our strategy and how we're now changing our strategy as a result of this, or to minimize this. Really, what the market expects is transparency.
Starting with Europe, you are working with Irish clients. Obviously, they're inside the EU, and you're working with UK-based firms who may still be subject to some crossover.
Yeah.
How then has how has the European sustainability reporting situation, let's call it that, and the omnibus affected or been kind of perceived by, let's start off with the UK companies, because I think the Irish companies, to most of the people in Europe who I talk to, they're in the same bucket. But particularly the UK, it's quite a unique geography with very strong political ties, but no longer in the European Union. What does it look like in the UK with all of this happening?
I don't like to make broad generalizations, but what I'm typically seeing is, so the top 2/3 of the FTSE 100 know that whatever happens with Omnibus, they're still going to be in scope of CSRD. So for them, it's been business as usual. But since Omnibus, there's been a shift in focus saying, well, actually, let's make sure this adds value to the business. We're not just doing this from a compliance perspective. There has definitely been a pause. This summer has, I've been in sustainability for the last decade or so, and this summer is the driest I have ever seen it, in terms of reporting, getting audit ready, just putting the infrastructure in place. And that's largely down to the uncertainty with Omnibus. And certainly, you never want to see how laws are being made. And as a Brit looking into the European Union right now, and I'm seeing the council at odds with the commission and the commission at odds with the parliament, and and in the middle is EFRAG being tossed about like piggy in the middle. It's a very uncertain landscape. And given the economic climate, why would people invest in something if that investment is at risk? So once Omnibus we've got real clarity over that, and that's what businesses need, is clarity. Once they've got clarity, they can actually proceed. But at the moment, we thought it was almost set in stone that the thresholds for CSRD would be lifted to, say, 450 million euro turnover, and I think it was 500 staff as well, though I could be wrong on that front. But then within a week, Parliament voted against it. So, it's an ongoing epic saga.
So the argument in favour of reporting is transparency, and the argument for transparency goes all the way back to classic economics, Adam Smith, right? The informed consumer. If people know what they're buying, they can make better informed choices. Therefore, it's in the consumer's interests, it's in the investor's interests, etc., for transparency. So the economy, if you are a neoclassical economist, a conservative economist, you should, in theory, argue that the economy will be better off overall if economics and transactions are more transparent. The second argument then is that any individual firm can benefit from doing these sustainability processes, from being systematic about what your risks are, what your opportunities are, being systematic about where your reputational impacts are, what your actual impacts are, focusing on that which is material and not focusing on that which is not material, and doing this in a structured way so that everybody is doing this in the same way, the skill sets are transferable, etc. Right. Now that is a self-contained argument that does not rely on regulation.
No.
Have we then proved that that argument is bunk? Because companies aren't doing it in the absence of regulation.
There is no such thing as an efficient market in the global economy. And the problem with, and the reason for that is because we're all human. And unless you take the humanity out of humanity, and I'd really rather we didn't, we're never going to have this kind of perfect, efficient economy. I will say, though, that I have seen very much a deterioration, certainly in the last 5-6 years or so, as we have shifted from, say, globalization to protectionist economic approaches. And I'm not an economist, I'm an accountant, and I don't do that stuff, but that has informed the corporate messaging that we see coming out of investor relations teams.
Just to sort of sum up the reporting, what's your feel of the overall market kind of sense, or the market response to kind of sustainability reporting right now? Are they keen but waiting? Have they had enough? What's the kind of motivation? Are we a year away for everything kind of coming back and it settling down and becoming a normal part of business again, or is this like some sort of fundamental shift away?
If we think about CSRD as a framework, then I'd say we have a very polarized market. You have those who are proceeding at pace and are going to be ready for it, others who will resist it to the nth degree, and then finally put some slapdash reporting together. If we step away from CSRD, the specific framework and the ESRAs, and we think about sustainability reporting generally, the actual trajectory is very clear for everyone to see. Everyone knows that they've got a journey with sustainability ahead of them. They know that it's going to be, eventually, it will come to be a condition of staying in that market. And so they're thinking about, well, okay, what really matters to us? What matters to our stakeholders? And they're thinking about, say, IFRS S2. They're thinking about TNFD if that's really the space they're operating in. And they're definitely thinking about the societal license to operate. And particularly on that one, that's when they start thinking about GRI. The challenge is that even with GRI, there's very little comparability between businesses outside of the established metrics. Even if you were to compare two businesses, carbon accounting disclosures, scope 1 and scope 2, you can do a decent comparison. When you get to scope 3, oh dear. And that's part of the challenge, is that some financial reporting has been around since the 1400s, and if not earlier, sustainability reporting has been around since GRI, and that was mid-90s.
Ignoring the CRCD then, there is talk and has been talk that the Commons are trying to introduce or pass a bill for some kind of sustainability related disclosures in the UK. Is
Yeah.
that going to happen, or what? I mean, I know that the political situation is somewhat unstable, and it's looking like things could change in the next general election, at least. What's going to happen, do you think?
Yeah, so we've developed UK sustainability reporting standards, which at the moment is IFRS S1 and S2, with only about 4 or 5 changes from the actual standard, which I think is pretty good going. And generally in the UK, if the IFRS Foundation, the ISB or the ISSB issue a standard, we try and adopt the full text with only tiny clarifications, just because the London Stock Exchange is such a major part of the global economy, or at least it used to be. In terms of UK SRS, they have been published. There was a consultation period over the summer. They will be finalised in the next couple of quarters. We're looking at the first mandatory reporting in the UK from 2026, and that will really be those businesses that are already in scope of TCFD under the UK framework, or they're large private businesses. It's not going to get to the SME sector, at least for a few years. The big open question is, which private businesses will be in scope of this reporting? Where will the government draw the line? And actually, to bring this in, it probably won't be an act of parliament. It will just be a statutory instrument that the government's empowered to bring out. So there won't even be the opportunity for debate or for voting in the UK Parliament on this. But on the whole, businesses are responding well. IFRS S2 isn't particularly controversial because it's yeah. I mean, it's what they're already doing with TCFD. The challenge is that so many businesses, even listed businesses, the TCFD disclosure is already quite boilerplate. And so there's a bit of a journey going, well, actually, you really do need to make this, tailor this to be more specific to your business.
I'm keen to hear like how you got into the sustainability sphere, and you mentioned that you'd come through finance and accounting. So what's the story there?
Yeah, so within finance and accounting, really I was always at the very technical end of the spectrum. So I was the accountant telling other accountants how to account for the really difficult stuff. So when TCFD first came along, or was in its very early stages, I was heading up accounting policy for a large listed group in the UK. And I saw TCFD was on the way, and I thought, this is the trajectory the corporate reporting is going in. I'd better clue myself up on this quite rapidly. So over the last 10 years since then, it's been more of a slow progression from financial into sustainability reporting. But that's my CV. What people won't see from my CV, for me, sustainability is personal. What's important is that we as sustainability professionals communicate the impact we're having, and that we can communicate the risks and the opportunities to people who can make strategic decisions that promote social justice, social equity, environmental justice, to ensure that no one's left behind. And that's really the kind of the driving force for me behind being in this world, basically.
We must be all very conscious that sustainability is it's a morally and ethically based thing to do in business, right? There is an undeniable ethical / moral component to this, and I'm motivated for reasons outside of just having a job. I think if I was, if I was offered better conditions to leave the sustainability sphere, I would think very long and hard about whether I really wanted to do it, because I just have this outside of work motivation to be
Yeah.
explicitly. For me, it's more on the environmental side. I'm quite weak, let's say, on the social side of sustainability. My background is more the E component, but yeah, that's really interesting. Then we're not the only we're not the only profession that's like that. There are others, teaching, for example, medicine. Um, how how ready do you think businesses are these days to accept the fact that people are motivated by things other than financial benefits to work, and their choice of career has an ethical or personal, spiritual or whatever component to it? Do you think employers are aware enough of this?
I think they are, because if nothing else, they're confronted by the generational shifts that we're seeing. We saw Gen Xers move into millennials. Now we're seeing millennials move into Gen Z, and I'm not sure what we call the generation after Gen Z, maybe AA or something. So they're aware of the broad structural shifts in society, and certainly tools like social media, AI have been a major part of that. Um, what we're also seeing is a change in the way people are learning in the workforce, how they're developing those skills. And one of the advantages of AI is that people can learn and acquire those skills before they even enter the workforce, which is itself one of the biggest challenges business has with academia, is that that there's at least a 2 or 3 year in-depth training process for someone to move from being graduate to making business decisions and knowing how to communicate in that setting. So as with anything else, there's always this peaks and troughs, seasonality in a way to the way these changes happen. But it's definitely there. Businesses, where I think the challenge comes is when we move into, say, ethics and morality, and say resisting the urge to preach to it become, you mentioned the word spirituality earlier. Are we becoming evangelists of sustainability? And that in itself, most people gets their backs up, because who likes being preached to? If you come at a traditional CFO who thinks in terms of rational, they trust the numbers, you need to demonstrate there is a financial ROI, rather than just saying, what's the future you want to leave to your kids, or something like that. So I think there is definitely an argument for talking about ROI. On the other hand, there's one of the best CSOs I've come across. She could walk into a board and say, what kind of business do you want to be? And that would work for her, because of the way that she's built those board relationships and the influence she has there. The challenge is that very few businesses have a CSO. So often you've got a sustainability manager or a head of sustainability that never even speaks to a board member, let alone gets to present to them. And that's why for the majority of businesses, I think, yes, we do need to communicate the ROI. If you've already got a place at the table, you don't need to earn it.
Right. Do we have to earn that place at the table? Or do we deserve it?
I don't think we should, but the reality is that we do. We do need to earn that. We need to demonstrate in practical, quantifiable terms the impact that we've made, and how we've solidified the company's future. If we can't demonstrate that, yeah, I'm sure we're having a great impact, but that impact can be very temporary. How do we keep going?
I'm fully on board with this kind of concept.